right, guys, good evening. I hope you're perfect. I hope you're doing well. So, we have successfully crossed over to the intermediate part of the lesson which we decided to do. Now, if you did not attend the beginners class, like very well, I will advise you to go back on YouTube where you have the recorded lessons and then you watch the first 5 lessons because I believe I want to deal with people who already have an idea of everything introduction to forex. We did the definitions, calculation of lot sizes, how much you will make or lose depending on the lot size you're using. We started basic market structure. Now, there are several things I'm going to teach you guys in this whole session. I promised you guys I was going to teach you smart money concept. I'm going to teach you smart money concept. At least I'm going to get you started on your smart money journey, and then I'm going to teach you ICT. Now, ICT is basically inner circle trader, and this ICT, there are several concepts on the ICT. So we're going to learn several concepts on the ICT, like the time and price, the market maker, sell and buy theory, the dealing range theory. These are things we are going to work on. Yeah, but like I said, slightly, okay, because there are certain things that you won't understand since you're coming from just a beginner. Yeah. And then if you don't understand this one, there's no way you're ever going to understand advanced um all of these other advanced courses or more deeper understandings to these things. And then I'm going to also teach you price action in another way. Okay, now we started price action under the beginner forex thing, but then right here I'm going to teach you price action as a confirmation trick. Okay, because now most of you, when we give out analysis, you don't even know how to take it. For example, I could send out this analysis and I tell you sell gold when you have the confirmation, and you're going to look at me and like, where should I sell? How should I sell? What is the confirmation? Because as of now, you do have to go down to your lower time frame to look for confirmation. So there are several things I'm going to teach you on that smart money concept, ICT concepts, and price action. Okay, so all I want from you is your due diligence, your attention, and then you being able to do your homework. At one point, I'm going to open that group so that you guys can interact and then send your homework respectfully. Now, we're going to go as fast as possible. We're going to start with smart money concept. When you hear smart money concept, what is that first thing that comes into your mind? Now, before we even talk about smart money concept, okay, we are going to talk about participants in the forex market because that is how it all starts. And this is one thing which I did not really talk about it in detail. So we're going to start participants in the forex market. So if you don't even know who is in this market, you will not know how to tackle them. You will not even know what to understand. Now, there are several participants in the forex market represented by all of these candlesticks. There are people, human beings like you and I, behind these movements, behind these candles. And I always say that the first participant in this forex market, okay, the first participant will always be participant number one, will always be the government. Okay, now forex is basically dealing with currencies. We mostly trade currencies here, especially like I said in forex. We basically mostly trade currencies. So you are trading currencies that belong to certain or different countries. If you're trading Euro USD, it means you're trading Euro from the Eurozone in Europe plus the US dollar from America. Okay, from the United States. So what does it mean? You are trading these two currencies. So who is the number one player? The government of the United States and the government in this European Union. So the government is the first person. if the government wants to increase maybe the exchange of euro to US dollar, they have what they do, which is what we are going to really talk about on the smart money concept. Someone is writing on my screen. Take it out. Good. Now, the government, if they want to make their economy very good, they have policies they are going to use, and before you know it, that's it. If they want their currency to be strong in relation to other currency, they know what to do, and before you know, euro will buy, or dollar will buy, or GBP pound will sell, so they know what to do. So the first player is the government. Now we have player number two. Player number two here are basically agents of the government, which are who? Big banks and financial institutions. So we are going to say big banks and financial institutions, FI. So we have big banks and financial institutions. These big banks and financial institutions, what do? They are acting mostly like your central banks, okay? Now, if you come from Cameroon, then you will know that any country around this Central Africa that uses SAFA is run by BEAC. BEAC is the bank of all banks, is the bank to these other small banks all around. Same thing, those who using Naira. Naira has a central bank. There is a central bank that is responsible for what? For the inflow and outflow of the Naira. And then all of these other smaller banks are just working, they're working under the directives of these guys. So the biggest bank here, like maybe in the US, you have the Bank of America. If you come to Europe, you have the bank of this, the bank of that. All of them, they have their banks that act as agents of the government, because when the government wants to pass out maybe a contractionary policy that might maybe make the currency to fall, they use these big banks as agents. So most of the times, these our smart money guys, they work hand in hand with big banks and financial institutions. In fact, that is where they are. So you need to know how big banks and financial institutions move the market. Now, you guys have been hearing me talking about supply and demand, supply and demand. We are going to work on supply and demand thoroughly. So that's why you have to go with me throughout this series, because these big banks and financial institutions, what do? They put in supply and demand in the market. Easy. Now, the third people we have in this market, in order of importance, we have hedge funds, okay? Oof, let me go back. We have hedge funds. Now, these hedge funds are companies that trade for people. Now, here in Africa, if somebody says, give me your money, I want to trade for you, they want to scam you. But then there are very legit platforms in the Western world. You go to Europe, you go to America, that act as hedge funds. They trade for people. They act as investment. They work as they are some sort of investment. You can bring your $1 million. They tell you, oh, we're going to give you 10% per year. You know, oh, at the end of 1 year, an additional $100K adds. If you choose to compound, fine. So these hedge funds, they are working under these other guys, these big banks, because these hedge funds, they need information. They need information. You guys will not just have, you see hedge funds having 100 billion US dollars. So do you think they will gamble with people's money? No, they have inside information. That's the truth. Because they need to know when sometimes this demand and supply enters the market. And then the last set of people in this market, you have retail traders. So you've been asking yourself, oh, where do I fall inside this whole gang? You fall here, retail traders. So you are a retailer when it comes to this market. You are the least under the pyramid and you are the majority. So this thing is like a pyramid. The government is at the top of the pyramid and he has the highest control. Next, you have big banks and financial institutions. Next, you have hedge funds. Last, you have retail traders. And retail traders make up the majority. And retail traders here are the least people who have information about what the market will do or how it will react, unless they use their eyes. So you are a retail trader. If you don't know how these other guys work, I'm so sorry to tell you goodbye. Your career ends because you will lose money in this market till you will say forex is a scam. Forex is not a scam. Forex is never a scam. But then knowing the wrong thing, it will definitely scam you. So these are the participants in the forex market. And I said smart money traders find themselves around number 2. We are there. Okay, so we are going to do supply and demand thoroughly. And when we start the supply and demand theory, I believe that's going to be the first topic we are going to start today. Supply and demand, so that we can start supply and demand from below, and then you understand what is happening. So retail traders make up the majority, and they're the highest set of people that take losses, that lose their capital because of what? Number one, they don't know how to trade. Number two, they lack inside information about what is happening. So in here, when you talk about smart money concept, ICT concept, all of especially these two concepts, smart money and ICT concept, these concepts are just brought out to enlighten you, to make you see the market like these guys, or even not like them, because they are the ones putting in these things in and out. So you are going to be thinking like them, meaning if they enter here, you're going to see them enter. If they leave, you're going to know, oh, they left from this area. I see their footprint. It's like you are following your account, and then you're following the footprints of your mother. Wherever she places her leg, that's where you place your leg. So with that, you will not make a mistake. Or even if you want to make a mistake, it wouldn't be as serious as you would have if you were working alone. Okay? My screen is not that clear. It's clear, probably from your end. So that's it. That is it. That is it. That is it. I believe as you're coming into this class, you have a notebook, you have a pen, because I don't want to deal with fellows that I take my time to teach, and then you take your own time. Don't write on my screen. And then you take your time to come to class, and you're lying on your bed while I'm sitting on my desk. So if you're lying down, wake up. I always say, if you're lying down, wake up and get a pen and a book. The first concept we are going to work under smart money. Okay, that will be our very nice supply and demand. Now, when you hear supply and demand, what do you understand? So, when you hear the term supply and demand, what do you understand? Supply and demand. What comes into your head? Supply and demand. What comes into your head? Let's be very fast. Write it down in the comment section. I'm not here to deliver a speech. When you hear supply and demand, what does it mean? Let's talk very fast. By the end of this series, you'll be able to at least try to analyze with some clarity. Yes. Or most of the trades I'm going to be sending out on Telegram, you will be at least able to interpret them and trade them by yourself. Remember, in here, I don't sell any signal because signals make traders lazy. So Samuel says buying and selling of something. Okay, buying and selling. Supply what is given, demand what people want. Okay, a very nice idea. So demand here, when you talk about demand, it means you are asking. You are asking. All right. So demand in economics term is basically the amount of something you are willing and able to buy at a particular price and at a given time. The amount of something you are able to buy. It could be a good or a service. Okay, at a particular price, you must add price. You must add the amount of the good or service, the price, and you must add the time. These are the three key factors of demand: price, time, and the amount. How much or how many shoes will you want to buy? At what price? At what time? So that's demand. Okay, demand is the amount of a good or service a customer, or call it a customer or a consumer, is willing and able to buy at a particular price and time. While supply is basically the amount of goods and services that a supplier is willing to supply to the consumer or to the customer at a particular price and at a given period of time. Because there are certain times where the demand of something is literally more than the supply. For example, during the rainy season, umbrellas are in demand. Many people want to buy umbrellas. So these suppliers will supply it at a particular price because at that time, the demand is high. And when demand is high, what happens? When demand is high, what happens? Guys, talk, please. Write it down in the comment section. When you turn to demand something a lot, what happens to the price? Exactly. The price goes up, the price increases. When demand is high, the suppliers will start making, they'll start feeling themselves like they're too important and they will tend to take price up. So when you demand something too much, you make the price to increase. Okay? And when the price starts increasing, consumers will lose interest. And when the price reach a particular point where consumers will they will not want to buy again at that price point, what will happen? Supply will start to enter the market. And now, if supply enters the market, when the price is high, will supply be will suppliers want to supply more or less? When price is high, will the suppliers want to supply more or less? Please, answers. When the price of a commodity is high, will suppliers want to supply more or less? More, exactly. When the price of something is favorable, imagine you're selling, for example, chicken. Yes, table chickens. You say, oh, you're selling those things. You're selling maybe a shoe, you're selling a bag. And umbrellas, like I said. This is rainy season, you're selling umbrellas. The more there is demand, price will increase. Now, when price has increased, these suppliers will do what? Suppliers will want to sell more. They will want to supply more because they want to make money. The goal of a supplier is to make money, while the goal of a consumer is to save. So that is why most of us love to buy things when it is cheap. Yes, when it's very cheap, that's when we want to buy. When price goes up, you're no longer interested. And then for suppliers is the inverse. So the demand curve is inverse to the supply curve. That's it. And at the point where they meet in the middle is literally called the equilibrium price. On the equilibrium price, what happens? Demand equals supply. At this point, both buyers and sellers are at equilibrium, meaning they are equal. The amount of goods that are willing to be supplied equals the amount of demand in the market. And with this, you come to stable pricing. Please don't write on my screen. So that is your supply and demand. So if you can understand that when the price of something, this is gold, okay, when the price of gold tends to really increase, come on, buyers will buy. At one point, when they are bought till their money is over, gold is no longer what? They don't find it interesting. Why? Because price is high. Who wants to buy when price? Like now, if I want to buy, for example, there's a bag I want to buy. No matter how I love that bag, if the price is too high, I'm going to tell myself I'm coming back maybe next week. Like now, this is almost Christmas period. Things are like the prices of all of these little things, clothes, shoes, they are increasing by the day. I'm going to say, no, I'm not buying this back again. I'm coming in January when this festive season has passed. So time and price, they're always working together. Time and price, time and price. That's why under ICT concept, I'm going to teach you a very powerful concept, which is time and price, because time is directly proportional to price. Right now, this is Christmas period, time. Things are expensive, price. When the time is right, price goes up. When the time is not right, price goes down. They're directly proportional. Same way, if you sell gold, sell gold, sell gold, maybe when gold was selling, the more it sells, it gives who? Buyers the opportunity to buy. You buy when price is low, you sell when price is high. So this concept of supply and demand will really help you in your day-to-day trading, because you're going to understand that when price is low, you have no business trying to look for a sell. When price is high, you have no business trying to look for a buy. Rather, when price is low, you buy. When price is too high, you rather have to sell. Are you understanding? If you're with me, please let me see you. Can we move? So I believe I'm trying my possible best to make you guys understand this. And it's just out of God in my heart that all of this is happening, because I teach when I was doing intermediate classes, like back then when I started this, I wasn't even on TikTok. Most people will pay me $50, yeah, for 2 week session just for me to teach them. But then this is us, we're doing it for free. I'm going to put it on YouTube for free so that you can end your year, with some knowledge that will help you next year. So trading is very easy when you understand supply and demand. So how then do you see supply in the market? Let me take out these things. How then do you see supply in the market? Now I said relative here on TradingView, black candles equals sales, blue candle equals buy. Your own could be red, green, blue, whatever color you like. The choice is yours. So when you see a black candle, it means sell. When you see a blue candle, it means buy. Now, supply means sell. So anytime you see a black candle, it means that what happened? Sellers are here. Sellers are here. Anytime you see a blue candle, it means that buyers are here. And then when you continually see many blue candles along a line, it means that buyers have been here continually. So you need to work on your time frame. Okay, if you look at here on my left hand, you see several time frames running from 1 minute right up to 12 months, which is 1 year. Now, the higher the time frame, the stronger it is. Okay, it means that if you see one blue candle on the 6 months time frame, it basically has more strength than one blue candle on the early time frame. So here is a 4H time frame. If you see this 1, 2, 3, 4, 1, 2, 3, 4. These are 4 bullish candles. What does it mean? It means that for 16 hours continually, buyers have been in this market. It means that demand has been prevailing. Now you wake up, you see 1, 2, 3, 4, 5, 6. You see 6 hours, no, not 6 hours, 6 4H candles. 6 times 4 is basically 24. That's like 1 day of continuous sales. Continuous sales, it means that sellers have been involved in this market since here. Now, the next thing which you're going to learn under supply and demand is supply, or let's say demand zones and supply zones. Now, demand and supply zones. What are demand and supply zones? Demand and supply zones are areas where you see supply enter and you see demand enter. So all of these candles can show a buy, but then just one candle shows where demand entered. For example, this one. So that's why if you want to mark out the demand candle, this blue candle literally, that's the first candle that expresses what? That, oh, buyers are in this market is this. So a demand zone, you're going to mark like this. Why will you mark a black, like the black plus blue candle? I always just mark like black plus blue. I will not want to just leave it on the black sometimes, because mitigations can vary, meaning sometimes price will tend to come back just to the blue one and all over. But then this is, if you want to mark it, this is how you mark it. Now, why will you mark plus this black candle? Now, the tendency of market makers or smart money traders is, if they want to buy, if they have plans, on buying, continue going higher, they have to sell first before they buy. So this period where they sell first before buying, that's what causes this movement. So when they want to take a buy, when demand wants to enter the market, they first of all need to put you in the market to sell. Now, the moment they put you in the market to sell, as you will be selling, I told you stop loss and TP. As you will be taking that sell, that, oh, let me take a sell. Gold is selling here, like this, here. You would have said, oh, gold is selling. Let me sell. And where are your TPs? I mean, where are your SLs? You were selling, your SLs were here, were here, were here. Okay, now imagine you sold and sold and sold and sold, and then you did not take profit. Just know that you would have taken an SL. Now, when price does this, as you are selling, the opposite end of your sell orders is basically a buy. That's how the market sees it. As you are selling, your sell order, someone is writing on my screen, please. Your sell order reflects as a buy in the market, especially from the end of these smart money traders, because they need the other end of the transaction for them to do what? For them to enter the market. The reason why you see this black candle, blue candle, black, that's because buyers and sellers coexist. Buyers and sellers coexist. I'm going to answer questions in the last 5 minutes. So buyers and sellers coexist in this market. The thing is that when a buyer or when demand is more than supply, price will buy, like here. And when supply is more than demand, price will sell. That's how it is. But they coexist. They coexist. So before they want to buy, they put you to sell. So as you're selling, you take a sell, you have a stop loss in the market. That stop loss equals a buy order. That's why when we are going to start talking about liquidity, you're going to understand so much. So as you're busily selling, you're busily selling, you're busily selling, they are taking a buy, they are taking a buy. Now, when their orders are filled, if they wanted to buy $10 million worth of gold, they are going to put you guys to sell. They will induce you to start selling. So as you're selling, they're taking the other end of your trade and they're putting their buys. So the moment they succeed, poof, they have their 10 million orders being filled. You hear order filled. After order filled, the demand has entered. So now how will you see them? By this kind of candlesticks. That is why you see that the moment price got here, what happened? You have a reaction. Why? Because demand is here, and the tendency of demand zones are, so long as price forms this demand and the demand is still fresh, price always react on it when it comes back there. We are going to learn qualities of good demand zones tomorrow. Okay, we are going to learn different qualities of a very good demand zone tomorrow, so do not miss demand and supply zones. So a demand zone, a supply zone is different from a support and resistance. I told you guys the other day that a demand zone, when price comes into it, severally forms a what? A support. For example, this now, let's say this is a support zone. I'm going to mark everything here. This is a support zone. Now, when price formed this, it mitigated it the same minute, the same hour, the next candle mitigated the demand. It was already done because a demand zone, a supply zone, is first come, first serve. When price has already come back to it, that's all. So the next time price came here, this was acting more of a support. Even now here, price is still acting on it as a support. So demand zones, when mitigated severally, or when price comes to it severally, forms a what? A support zone. And for a resistance, the inverse is true. An area where sellers have entered multiple times. Anytime price hits that zone, you're going to get sellers enter. And you always start with what? A supply zone. I'm going to give you guys examples, a lot of them tomorrow. So it always starts with the supply. Now, the moment price mitigates that supply is over because it's first come, first serve. And when price comes already, that's all. The next time, if price ever comes and reacts, it's going to be called a resistance. And the tendency that price is going to come back there and then keeps holding is very slim as price keeps coming. And then the next thing you're going to have is a breakout. Either you're going to have a real breakout or you're going to have a fake breakout and price to continue to go down. And you realize that all of this now, this bar movement here was just to raid all of your SLs above this high, and then the remaining does that it continues to sell. So either you're going to have this as a fake out or a run on liquidity. Like I said, we are going to progress and you will learn these things, or you're going to have it as a breakout structure and like that. So you guys, we're done for today. Ask your questions, ask your questions, ask your questions as fast as possible. And then from there, we're going to end our lesson. Can you go ahead and ask your question? Okay. So each time frame, for example, one candle on this 4 hours time frame shows that the candle was there for 4 hours. And if you go to the daily time frame, one candle represents 24 hours of price action. Okay. Who is already asking about confirmation? I said ask a question based on what we have learned. You don't know stop loss and TP, just go to the videos on the YouTube channel. It's free. Go and watch. We did all of that. Okay. How to spot a valid support? No, it's not how to spot a valid support. How to spot a valid demand and supply. Like I said, topic for tomorrow. Must there be a demand or supply zone for price to react on? Must there be a bed for you to sleep on? Answer. How do you interpret your chart when you post them? We're going to work on that. No, we cannot unmute for us to have clarity. Can you explain I don't understand. All right. So tomorrow we are going to come back and then we are going to continue demand and supply. Please, I would love to have a recap on PIPs, TPs. It's on the Telegram channel. Sorry, the YouTube handle. Watch it. You can watch it tomorrow. It's on YouTube. So you guys, day one exhausted. We're going to come back tomorrow, same time, 8 p.m. And then we continue from there, everything being equal. Okay? All right, you guys. All right. See you.